Financialization, understanding its role and impact. Financialization refers to the increasing dominance of financial motives, markets, institutions, and elites in shaping the economy, corporate behavior, and societal priorities. Over the past few decades, it has transformed how businesses operate, governments function, and individuals engage with the economy. Its influence stretches across sectors, driving decisions that prioritize financial returns over long-term growth, impacting both microeconomic and macroeconomic systems. Financialization is characterized by the rising importance of financial markets and instruments over traditional economic activities such as production and trade. This shift has led to a restructuring of economic priorities where financial markets often dictate corporate and governmental decisions. Businesses focus on maximizing shareholder value, often at the expense of broader objectives like innovation or sustainability. At the household level, financial products and services increasingly dominate people's lives, from mortgages and credit cards to investments. The roots of financialization can be traced back to the 1970s, a period marked by the deregulation of financial markets, particularly in countries like the United States and the United Kingdom. During the 1980s and 1990s, globalization accelerated this trend, integrating financial markets across borders while institutional investors gained prominence. The early 2000s witnessed further transformations, with technological advancements enabling high-frequency trading and the creation of complex financial instruments like derivatives. These developments reinforced the central role of finance in shaping economic systems globally. Several factors have driven the rise of financialization. Policy shifts favoring deregulation have reduced oversight of banking and financial institutions, enabling rapid market expansion. Globalization has facilitated cross-border capital flows, further embedding financial markets into global economic systems. Advances in technology have revolutionized financial systems, introducing algorithm-driven trading and high-speed transactions. Cultural shifts, particularly the growing emphasis on financial metrics like stock prices, have further entrenched financial priorities in corporate and public decision-making processes. The effects of financialization are profound, particularly on corporate behavior. Many businesses have shifted their strategies to prioritize short-term profits, often neglecting long-term investments in innovation or infrastructure. Stock buybacks and dividend payouts are favored over employee development or research and development. For example, General Motors significantly reduced its workforce in the 2010s, while directing profits towards stock repurchase programs. Financialization has also contributed to widening economic inequality, concentrating wealth among financial elites and institutional investors. As financial markets thrive, wages for workers often stagnate, leading to an increasing gap between the wealthy and the working class. Rising CEO-to-worker pay ratios in financialized economies illustrate this trend. Economic instability is another significant consequence. The focus on speculative financial activities rather than productive investments has made economies vulnerable to crises, such as the 2008 global financial meltdown. The subprime mortgage crisis in the United States, driven by financial institutions repackaging and selling risky loans, is a stark example. Additionally, financialization has influenced governmental priorities, often encouraging policies that favor financial institutions over social welfare. Privatization of essential services like healthcare and education is a common result, limiting access for marginalized populations and deepening social divides. Financialization has faced substantial criticism for undermining sustainable growth and exacerbating social inequality. Economists and policymakers argue that overemphasis on financial metrics stifles productive activities, weakening long-term economic foundations. In response, reform movements advocate for greater regulation of financial markets, fairer taxation of financial gains, and policies that prioritize economic inclusivity. These efforts aim to realign financial systems to serve broader societal goals rather than dominating them. Financialization has profoundly shaped global economies, influencing corporate priorities, widening inequalities, and increasing vulnerabilities to economic crises. While it has generated significant wealth for some, it has often done so at the cost of broader societal and economic stability. Addressing the challenges posed by financialization requires a balanced approach, ensuring that financial innovation aligns with long-term economic and social goals. Only by integrating inclusivity and sustainability into financial systems can their benefits be equitably distributed, creating a more resilient and just economy. Stay tuned for more insights into business and the social sciences. If you found this overview helpful, don't forget to like, subscribe, and comment on future topics you'd like us to cover. I'm Dr. Dog, wishing you a fantastic day ahead.